All right, everybody, this is being recorded, and one thing I say about options and these webinars in particular is if you're not new to, or if you're not used to trading options, or you're new to this particular strategy and or options, watch this again. It'll help get everything sinking into that long-term memory so some of the nuances aren't lost on you. If you wait a week or month down the road, it's going to be like learning it all again. So watch it again, get used to this, and it will make it sink in and you'll really understand it a lot better. Anyway, this particular options workshop is going to be on how to implement a collar. Now, last week we did the covered calls, and a lot of people were questioning, well, I had on a covered call one time and the market dropped out a bet on me and lost a lot of money, and how could I protect that? Well, this isn't one of my favorite strategies, but it is going to be more profitable than just having stock alone, because for one, you can protect yourself to the downside, and you can sell a call against it, because as we all know, the market moves up and down, and this would be a good way to, instead of putting out a limit order to just sell a stock out at a certain price, collect a little bit of credit for that and have that put in there. We're not going to be able to collect a lot of credit for this strategy, but we're going to be trying to at least do this strategy for a credit or a scratch. We don't want to be paying money for this, because that increases our basis on that stock that we bought, which means we're paying more than what we would normally have in just an open market buying that stock. So this is great for if you have a stock portfolio, you're going into earnings. So this could have been like part of that earnings series that we did, because you want to protect your gains on this stock, and you also, if you get a big huge jump, get that stock called away from you and wait for it to rebound. Because generally speaking, even in earnings, when they have gangbuster earnings, a lot of times you'll see that huge spike, and a lot of people are going to take advantage of that opportunity to get out for some profits on their stock, and you'll see it come back off. That would be the time to re-implement that long stock position. So that's where we're going to kind of play around with this. And I'm going to show you different ways to set this up to increase your probabilities of success. But it's a great one to put around to protect your stock during earnings. It's also, we're talking about historical highs in the stock market right now. So when a stock's at a 52-week high, this is when I would look to implement that, because it's going to find a lot of selling pressure anytime a stock gets to its 52-week highs. It may hit that 52-week high, come back off, and then rally up again. But what we're looking to do is try and sell some calls right around that historical high for that stock, and or you could even do this around, wrap it around a full portfolio. So like I said, we're going to try and do this for a small credit, and hopefully this will work out nicely for us next week when we start looking at some of these. This is going to be a market neutral to slightly bullish assumption in the overall market as well. So we're not looking for the market to sell off, but we have our protection if it does. Let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started trading my own money while I was in college with a really small portfolio, and started playing around with options on a few stocks that I had and decided, you know what, I didn't want to stay with my psychology degree and switched it over to finance after like my second year in school. Then after graduating with a finance degree, I moved to Chicago and literally just walked onto the floor of the Board of Trade and started handing around my resume, trying to find a job. Started out as a clerk and still continued to trade my own portfolio, and then moved up into the pits and started trading from there on out. And now that the pits are closed, I'm trading online like the rest of you guys. Anyway, I've traded most markets throughout my career. I've traded everything from stocks, financial futures, commodity futures, and currencies, and options on all of these products in all market conditions. So I've been through a lot and seen a lot. One thing I want to do, I have to go over, is this disclaimer. It says any opinions, news, research, and analysis or other information contained here or information provided by ProTrader Strategies and associates or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies, basically. And the reason why we have to say this is we're here to teach you guys how to swim. We're not here to swim for you. And I feel I have a fiduciary responsibility to you guys, and in that it would be that I can't really just tell you to go out blindly and buy a certain stock at a certain level or put on a certain strategy in a certain condition, because my risk parameters might exceed what your risk parameters are. The other thing is, what I'm talking about, or the stocks I'm implementing, could be counterintuitive to what you already have in your portfolio. So the idea here is to take what we're teaching you here and implement it into your portfolio in regard to your risk parameters and what is appropriate for that portfolio. So that's what we're trying to teach you, how to manage your own risk at the end of the day. And the bottom line is, do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. One thing to go over real quick before we get going, I'm on Twitter, so if you guys want to follow me, you can follow me at Wolfman's blog, and you can follow ProTrader Strategies at ProTrader Strat on Twitter. So you get a lot of useful information from ProTrader Strat, and you get a lot of snark and some trades that I throw out, especially during earnings season. I'll kind of throw them out there, tell you what I'm doing. You know, it's kind of up to you guys. You guys will know exactly what I'm doing. If I'm saying I'm doing a straddle or a strangle or something like that, you'll know exactly where I'm hitting those strikes just based on my rules and everything else that you've learned. So it should come pretty easy. And if you don't, you can always write to me at ProTraderStrategies.com, trading at ProTraderStrategies.com. All right, so this collar strategy is great for portfolio protection. That's what I was talking about. You know, you're going to limit your risk to the downside. You do, but in that you are going to be capping a little bit of your upside potential. But as we know, markets go up and down, and anytime you're implementing a strategy, especially we're going to be trying to do this one for a credit, you are actually increasing your probabilities of profit. By lowering your basis means you're lowering what you paid for that, and you can get out at nice levels as well. So we're going to be working around that. This is how we set up a collar. Basically, we're long the underlying, and then we're going to buy an out-of-the-money put, and then we're going to sell an out-of-the-money call to finance that put we're paying for it. That's why we don't want to pay a debit for this spread, because if we're paying a debit for the spread, it increases our basis. It's increasing what we paid for this long underlying. We don't want to do that. We always want to try to at least, you know, keep what our basis is, what we originally, or what we have paid for that stock, I should say. So if we paid $100 for that stock, if we can continually get a little bit of credit using this strategy or any other strategy wrapped around it, like the covered call I talked about last week, then we lower what we paid for that. We won't have paid $100 at the end of the day. We're going to end up paying a little bit less for that. So that's the ultimate goal. And if you can lower your basis on that, you're increasing your probabilities of success with these portfolios. So always try to lower your basis if at all possible, because that will ultimately increase your yield and increase your profitability. Picking the right strike. Now, with this, I'm looking at trying to pick a one standard deviation move, and I usually have a slide for this, but it wasn't showing up very well. This is a little bit bigger, I believe, and it also doesn't get pixely. Anyway, so we're going to be trying to pick the one standard deviation call or put and the one standard deviation call. So at the end of the day, the probabilities of it, rallying up and hitting our call within the time frame we're going to be looking at is only about 16%. So in that, if you beat the probabilities of it rallying up there and hitting that, then that's a real tough situation to handle, right? You're really profitable. You beat the probabilities. That's the beauty of this. You can't be upset that the market outpaced what was expected or what the probabilities were. Anytime you can beat the probabilities, you should always take that and be happy and walk away, because collecting money is a rich man's problem, right? So that's why we're going to be trying to set this up. And if we can lower our overall basis, what we paid for that stock, then we are setting ourselves up for success. So we're trying to pick a one standard deviation call and a one standard deviation put. All right, so picking the right duration. We don't want to be in this forever, because over the long haul, a lot of things could happen. You might want to put this around earnings for the just that earnings, and then we'd go into the weeklies. We'd go into this shorter duration here where it's just like 1 or 2 days before that earnings event. So that would be the time frame we would do if we're looking at earnings. We're going to go to the weeklies or the shortest duration we can find. But if we're going to be setting this up for the long term, we're kind of in between earnings right now, this would be the time frame we're looking at. About 35 days is where I like maybe even inside that. Some of my other strategies that I talk about where we're doing option collection strategies, I like to set them up just outside that 35 days. But with this one, I'm going to be going just inside of it. So right around 35 days or less, if at all possible. Closest to 35 days is what I usually kind of go with. And picking the right market or environment, this is a bullish to market neutral strategy. So we don't really want to implement this strategy if we're really bearish. I mean, at the end of the day, if you're really bearish, then you might want to just sell out that stock and put your money somewhere else that might get you more money. But it is still a neutral to bullish assumption on this. So that's what we're looking for. And if you can find high implied volatility, that's all the better, because we are going to be trying to collect a credit, and that would make this strategy work out a little bit better. But because we're buying a put and selling our call, it's just it's kind of a wash. So when I'm usually talking about using this in a high implied volatility environment with most of my strategies, it's not necessarily needed for this one. We could do it in a low implied volatility environment. And then picking the right underlying. There's stocks out there that everybody's heard of, like Pfizer possibly, and AutoZone is one I always think about because it's a big price stock, but the bid ask on some of those are really wide. We don't want to really do that around the option, even though the underlying trades a lot, maybe trade several million contracts a day, there's just not any participation in those options. And if you get in that situation and really don't know what you're getting yourself into, you're giving up a lot of edge on both sides. You're giving up edge to get in. If the bid ask is, say, 50 cents wide on a $25 stock, that's a lot of money to get in to start trading, and then you're going to have to give up a lot to get out. So that's going to eat up our profitability and eat up our overall yield at the end of the day. You might have this on for a long duration, think you're going to have a profit, but you just have to you settle for a scratch because you had to give so much up to get in and then so much up to get out. And then that really doesn't make it worth all of the effort. So make sure that the bid asks on these option contracts are pretty tight with those underlyings. And Apple's a great example of very tight bid-ask markets. There's a lot of participation in those options contracts. So one of the rules of thumb I go with for picking the right underlying in the options is that if it's a $100 stock or less, your bid ask should be within 10 cents wide. So the bid 10 cents wide to the offer, all right, on a stock that's $100 or less. Anything over that, I usually just say, look at what the price of the underlying is trading, move the decimal point 3 ticks to the left, and that's how wide those bid asks should be. So if it's like a $300 stock, you move that decimal place 3 ticks to the left, and you have 30 cents. So that's what you're kind of ballparking your gauge around. The higher you go, the wider those bid asks are going to be, obviously. So it's pretty lenient on that, but that's your ballpark. You wouldn't want to go in there on a $300 stock and they're 50 cents or $1 wide. That just does not make sense. Don't do it. Don't even waste your time. It's just going to eat you up, especially if you decide you really need to get out. Then it's not going to happen. All right, and knowing our exit strategy before entering the trade. Something like this, we're going to be really riding this out. So even though you know your exit strategy, it's defined risk on both sides. So if this stock rallies up and goes through my calls, I'm going to let that stock get called away. I'm happy because I've gained all of that movement to the upside. You're taking profits. Nobody ever went broke by taking profits. And if it goes down and hits my puts, then I'm happy to get out at that price because I'm saving myself a lot of anguish to the downside, especially if it moves down 1 standard deviation. That's probably going to not be a very good sign for that stock. All right, so our max profit is going to be that short call minus the underlying price plus the premium, because like I said, with this, we're going to try to collect at least a small premium. All right, so the other thing is if the stock goes through us a little bit, we could decide if we didn't want this stock to get called away and it goes through that short strike, you are still participating on the upside during the life of that options contract through that short call, albeit you're not going to get a 1-for-1 like you would if you were just owning the stock. For every dollar increment higher, you're gaining $1 for that underlying. With this, because of the deltas, the calls are actually going to increase in value, but they're going to increase in value at a slower pace than what the underlying stock is. So it could go through our short stock or a short call, and we would still be able to gain a little bit of money on the upside there. So if you're deciding to close that out at that time, then that would be still profitable, albeit not as profitable. Is there also high liquidity with a tight bid ask? Yes, a tight bid ask is indicative of high liquidity, and a wider bid ask is indicative of lack of liquidity. Basically, you get into a market of a stock that is like $50, the underlying is trading $50, and you look at that stock and you see like a 35, 45 cent wide market. That's just because somebody's in there, bidding 25 cents at 75 cents, and they know if somebody is silly enough to come in there and hit them on either one of those offers, they can immediately offset it with the with something else, like they would go in and probably buy stock, if you buy stock or short the stock, depending on what type of trade happened, whether it was calls or puts. So they're looking at arbitrage opportunity in there, and that's not what we're looking for. We're looking to increase our yield by lowering basis and protecting some of our gains. So we have a different strategy involved. If you're a market maker, that's what you do. You're trying to look for arbitrage opportunities, and that's not really what we're looking to do. So that's why you look for those tight bid asks. That is indicative of high liquidity. The other thing is when the markets start getting volatile or juking around, if you're in one of those stocks that doesn't have liquidity or it starts out with a wide bid ask, that bid ask is going to probably get 2 times as wide. So if it started out at 50 cents, it's probably going to be $1 by the end of the day, because a lot of people are just going to widen out those bid asks on those stocks because they know that not a lot of participation's in there, and they're going to go manage their risk in the ones where everybody else is participating. So it's a double-edged sword there also. So keep that in mind, that everybody floats to liquidity, and that's what we should do as well, just to save ourselves a lot of headache and a lot of money. All right, and then our max loss is going to be the underlying price minus the put price minus the premium. So remember, we're still trying to collect a credit here for this. So if our underlying price is 100 and we're doing, say, the 80 strike, it's at $20 minus the premium. It's going to be our max loss. Well, and it could be the other way. It could actually be plus the premium if we collected a credit. So if you added that premium in there, actually, no, it's right. So $20 minus the premium. So if you collected it, 50 cents, it would be $19.50. And then our break even is going to be that underlying price plus the premium. So whatever our underlying price is, we can add in what our premium is, and that is going to be where our break even is. So actually that's the one that is looking funny to me, is the underlying. If we collect a premium, our break even is below where the underlying was traded at when we first bought this. So if we bought it at $100 and we collected 50 cents, $99.50 would be our premium that we would have collected on this. So that should be a minus sign right here. So this should be minus. So minus our premium, underlying minus the premium there, because we're lowering our basis. And this is the assumption that we are collecting a credit for these. All right, so let's get out the platform. And this is usually when I talk to you guys about, hey, throw out different strategies or different underlyings that you guys like to trade. To give you the example of what I was talking about, NVIDIA has pretty good markets, generally speaking. As you can see, it's a $100 stock, and the bid ask, let's look a little bit further out. NVIDIA is a little bit wide right now, but I trade a lot of NVIDIA, and I know, as you can see here, there's a lot of volume going on in there, a lot of open interest. You wouldn't give up the mid price on this. I would probably, if I was selling something in here, I would go, a nickel or two above where I'm trying to collect my credit, and then move it down. That's another thing, you guys, is anytime you're putting on a strategy, if you put it in to the market and you immediately get filled, that means you gave up edge, and that could cost you a couple pennies here and there. If you do that over the course of time, you've given up several pennies and even dollars throughout the course of that. It doesn't cost you anything to put an order in above where the mid price is and slowly cancel, replace it, lower it as you go. Or if you're trying to bid for it, bid a little bit, below the mid price, and you're just making the market better. Somebody's waiting out there in the weeds for you, is what we used to call it, and they're waiting to trade with you. If they see a better bid or ask, they're going to hit it. So it doesn't cost you anything to put it in a little bit higher than you expect to get filled, and then cancel, replace. And I'm not saying wait 5-10 minutes. I'm saying put it in there, and by the time you go back out, change your price, hit, confirm and send. All of that time in there should have been enough time for somebody or these algos to kind of trade with you. So it doesn't cost you anything to put it a little bit higher and slowly change that price, over the next couple of minutes. But it does cost you money if you put it in there and boom, you got hit. There's a likelihood that you could have gotten at least a little bit better price. So always play with that. All right, Apple is a good one because there is a lot of open interest in there as well, and it's going to show that it has, you know, NVIDIA had 20-cent wide ones. This is over $100 as well. But as you can see, they have 3-cent wide markets all the way, 2-cent wide markets throughout, and obviously a lot more open interest than even NVIDIA. So Apple's a great example for this. You know, another thing to look at is they are very close to their 52-week highs, which, you know, they aren't going to have earnings for a little while, but this would be the perfect scenario. They've had a nice big run after selling off. It's going to find resistance up here. You know why? Because the last time it was up here and those people rode this all the way out, right? Think about your psychology. You know, one thing I said on the floor of the Board of Trade was psychology was probably a better education for me than even finance was. So, you know, this is you're right. So Apple is going to be having earnings probably right in here. I'll have to double check that. It doesn't show it up on here. But that being because, you know, the psychology of the market, if you think about the person that owned Apple and watched it rally all the way up here and then held on to it and watched it go all the way back down, you know, and thinking it was going to go to 100 and just kind of freaking out. Now that it gets back up in here, if you were that person, you're pretty trigger happy, right? You're going to have your finger on the trigger. So at the end of the day, I would look at it like I would be happy to sell my Apple up here and then try and catch at least a dip back down, you know, and then re-implement a new long position. So it's great around those, and then the earnings event. So if the earnings event is coming up here, and it looks like it is in, sorry about that, January. Let me just look at this one. It's not on expansion. So January 25th. So if it's January 25th, I might hold off on doing this one because it could go up a little bit higher. And then I would probably implement it maybe 1 or 2 days before that earnings event. So that would be a time to look at that. But we could play around with it like as if it's not, or we could even, because there's such tight markets and only a little time left in there, we could even look at it right now for the shorter even duration than what we were talking about with the strategy there. Oh, my computer's been giving me fits this week. I might even have to log out of this particular, wait for it to respond. Let's just, hold on. Give me 1 second here. Bear with me. I don't have any positions in Apple anyway. Let's see. All right, there we go. Decided to work for me as soon as I got ready to pull the trigger on a different platform. All right, so let's, you know, we could set this up now and again later right before the earnings trade. So we're going to be looking at the 16 delta. So anything close to the 16 delta. So this is going to be pretty much of a pick'em right here. You know, if you're more bullish, then go a little bit further out, but I'd probably lean towards these 18s. So in that, if I want to lean towards these 121, that's well above the high. I want to try and look down here and look at something that would be able to be financed, which is going to be these 114. So closest to, I'm going a little bit further out, and if you're a little less comfortable with it, then you know you can tighten it up. But closest to about 1 standard deviation. And so we're going to sell these calls, and then we're going to buy these puts down here on the 114s, because that's, oh, we're going to have to buy the 113s if we do that. So I'm going to actually go to these. I'm going to sell the 118s and then buy the 114s, so we can do it for a slight credit there. And even 121 is, well, you know, it's what, $3, $2, $3 above where its historical high is. We're collecting a little bit of credit, which is good. That helps us out. We don't want to be paying for a debit. So that's why I play around with those like that. I look for the one that's around the 16 delta, call to sell, make sure I'm comfortable with getting out at that level, which I would be definitely comfortable getting out of Apple at that level, and then look to the puts and see where I can buy those puts for less than what I collected for the credit, for the calls, I mean. Does that make sense to you guys? So that's how you would set it up. And I think it was Andrea was last week was talking about a stock where she lost a lot of money to the downside. And I talked to, you know, if you have a smaller portfolio, this probably isn't necessarily the best thing. You could look at the poor man's covered put or poor man's covered call for long positions, poor man's covered put if you want to be short something or short the underlying, like if you were short Apple, and different ways to trade around that. But the poor man's covered call for the smaller portfolios is probably a better choice than getting long a bunch of stocks and then trying to lower the basis. It's just a higher probability trade. You use a lot less margin, and you know, which ultimately increases your return on capital and everything else. Okay, you're trying to use this in your IRA for Apple. This is IRA appropriate if you are long the Apple already as a long stock. And remember, for every 100 lot you're long in Apple, you want to do this as a one lot. And as a matter of fact, you know, I wouldn't even cover all of it. If I had, you know, say 200 shares of Apple, then I'd probably still do a one lot and then only hedge maybe half of those. This is not a new strategy for new underlying positions, correct? Brad, yes, it can be. Like, you absolutely can build this all at once. You could buy, well, I don't think you could actually do it all as one trade, like, but if you went in and bought the underlying and then went in and added this, you could do this all as an opening position in a sense. So yes, you could. But better yet, if you have a portfolio of long stocks, you know, this is something you could do around that. Does that make sense, Brad? But always make, the real key here is making sure we get a credit, because we don't want to be paying, you know, we don't want to increase what we paid for that stock over time. Does anybody else have any other ones you want me to go over real quick? You can also do this if you have several stocks in your portfolio. You could even do this. It wouldn't work necessarily in an IRA because you have, you know, long stocks. But if you had a margin account, you could do this with, you know, if you had $100,000 portfolio, you could do SPX, something like that. Make sure it's appropriate to your portfolio as well. As we've seen lately, you know, you've seen the NASDAQ really rallying while the Dow's been coming off, because there's been like a sector rotation. Actually, the NASDAQ was coming off and the Dow was rallying because there was a sector rotation going on where people were getting out of tech and getting into some blue chips and some small caps. So make sure, you know, what is in your portfolio and you're doing the appropriate ETF against that. So if you're long tech, you'd probably lean towards the NASDAQ or the, you know, the triple Qs or something like that, where it's more tech heavy, rather than if you were long a bunch of blue chip stocks like IBM, Coca-Cola and things like that, Caterpillar, then you would probably lean towards the Dow. So keep that in mind as well. All right, so Caterpillar, let's look at Cat.
All right, let me delete this out. And let me find one that has something on expansion so I can see. So Caterpillar, unless you know when Caterpillar's earnings are right off the bat, they do have dividends within this January contract, and they also have it right there on the 26th. So right when you're out of earnings season, you're right back in. That's the beauty of it. All right, so then in that regard, we would probably be looking at these Jan 14s just to protect ourselves in the meantime. Again, almost everything we're going to be looking at is very near the historical highs. Depending on your overall economic outlook for this, then look at that as well. So the closest one I can find that's probably the 16, or closest to the 16 delta, is going to be right there. So let's just go 26 of these. So the 16 delta would be these right here. So we're going to try and finance that one with the 87.5. So we'd sell the 96.5s, and I don't know, I always have a little bit of a thing about selling the half strikes, but it's up to you. Just as, all right, so those have pretty good open interest, so I wouldn't worry about it. Always, anytime you have the half strikes, I always double check it, because sometimes there's just not a lot of open interest on those half strikes sometimes, so just double check it. So it seems like we're pretty good. So let's look at the, it'd be a pick 'em here. I'd probably lean towards these just to collect a little bit more credit. So we'd sell the 96s and then buy the, we got 32 cents, probably 33 cents to play with, and we're going to be buying the 88s. Okay, so that gets us a small credit, which is fine. Anything, you know, even to a credit is what we're looking for there. So if you're long the underlying, this would be a good one to implement around that. Stay away, try and stay away from the earnings plays. You know, once earnings comes around, then I would probably bump it out, and it'd probably be one of these weeklies, because I know Caterpillar usually has pretty good tight markets in the weeklies. As you can see, it's still inside of 10 cents, even for a weekly that far out. It's pretty darn good. And right around earnings, that's going to be even tighter. It'd probably be inside of a nickel, so that would be a good one. Can you do this strategy along with covered calls on a stock in an IRA portfolio? This would be in lieu of just doing a covered call. I would always lean towards the covered call. But we got a lot of questions last week about doing the covered call and adding a put to it. And so, you know, this is exactly what that is you wouldn't really do a covered call and then do another one of these. For one, you're probably not going to be able to do that in an IRA unless you have enough stock on the underlying. But if you wanted to maybe hedge all of your stock to the upside, I mean, you could play around with that. Like, say you're long 300 or 400 shares of Caterpillar in your portfolio or in your IRA, then, you know, maybe sell a one lot that's a collar, and or maybe a two lot as a collar and a one lot as a covered call, something like that. That would lower your overall basis, what you paid for it. And if it blasts to the upside, then you're still going to be long some stock outright. Okay, does that make sense? Yes, this is a good one to protect through earnings, especially if you know, had this stock forever for a long time. It's a really good way to protect your downside if something unforeseen happens. And if you get a big blast to the upside, you know, a lot of times you will see, even though it blasts up, it'll have a tendency to come back off. And if it's gone through that 16 delta call, that's been a big move. I mean, that's, you know, like I said, it's only going to happen 16% of the time. So over the course of doing this consistently, you're going to have 85% winners with this strategy, and about it's probably going to be closer to 70-something% winners with this strategy rather than having to worry about the downside. All right, I think I got everybody's questions there. So GLD. Oh, wait. Oh, you're looking at Gilead. GILD. All right. So Gilead, $75 stock, 15-cent wide. It's not bad. I think that Gilead usually has, I trade a lot of Gilead. So, and they usually have tight markets, as you can see. I mean, it's slightly outside of 10 cents on some of these, but it is a Friday. Some of these markets are a little bit wider now, but I mean, you can see 3-cent wide, 3-cent wide. So somebody just kind of pulled this one out or traded a lot of it right at the end of the day. Could have been. And Gilead has, let's just check sorry, I keep backing up too far and giving you guys a ring in the ear. So Gilead also has their earnings in that February contract. Their earnings are on the 7th. So you could even look at maybe trying to go inside of that, which would be these. And as you can see, they're still pretty close to 10-cent wide markets in here, generally speaking. So you could do it one of two ways. Get out right before the earnings and then implement this in right before that earnings. I wouldn't, if you're going to implement this, say, on Monday, I wouldn't try to capture that earnings cycle right now. Wait to protect yourself right before that earnings. For one, you're going to be able to get a lot further away from where the current underlying is trading, because implied volatility is going to have expanded to its greatest point right before that earnings event. And that allows you to get further away from where the underlying is trading. That's why it is nice to have high implied volatility when implementing this strategy, because as implied volatility increases, it will move this out because it's expecting a bigger move. All right, so that's why I wouldn't want you to do this now and watch this implied volatility expand where it currently is up to, up around here, because you would have been able to, if you had just waited, you would have gotten better levels for the most part. Does that make sense? How many days before earnings would you put this strategy on in general? I would usually do it, I would probably do it the day of, or, if it's a morning release, which I think Caterpillar, I think a lot of times releases in the morning. But if it's going to release in the morning, then I would wait until the second afternoon on the day before that morning release. If it is going to be released after the close, then again, I would wait until that day that earnings were going to be released, afternoon, to put that on. Is how I play all my earnings, is I do all my earnings setups in the afternoon, the day of, or if they come out in the morning, then the day before, right? Is this only an earnings strategy? Or no, this is not an earnings strategy play. This is, to protect yourself, protect gains. A lot of times, like, if you were going to put in a limit order, maybe get out of this, then, but weren't really sure, you didn't want to get clipped on the upside or whatever, you're going to be able to put this sell order, in a sense, further away from where you normally would. And it will protect you, again, to the downside. And hopefully, if you can do this for a credit, then you will lower your basis, which means you are lowering where you originally paid for this. So you can do this after earnings as well. Absolutely. Absolutely. You can do this really anytime, but you know, it's a matter of timing when you would want to. You just want to be always conscious of that earnings, because like if we were to put this on right now, if we were to put this on right now for that earnings event, which is right here on the, I think, what did I say, the 7th or something, volatility is likely going to continue to expand. It might come off a little bit, but it's going to continue to expand, which, given that, then we could likely see an opportunity where we would have been able to get further away from the market. That's the key takeaway here. As volatility expands, it allows you to get further away from the market. But again, it can be put on at any time, really, because volatility is going to affect it. The problem with selling strategies and collecting a credit a lot of time is as volatility expands, that usually hurts that short premium strategy you have on. But volatility kind of being a fear indicator, and it really pumps up puts prices more than it does calls, it really doesn't affect this strategy in the same way, because we're short a call, that'll increase in value, and we bought a put which, with volatility expanding, would increase in value, and it could increase in value quicker than our short call increases in value. So that is a possibility. It doesn't always work out that way, and that's why I would hesitate to do that on the expectation of going into an earnings trade. I'd like to have it clean if I'm doing it for a longer duration, and then I always put my strategies on for earnings right there at the pretty much the last moment, if you will, or the last couple hours, because then you've really captured that one standard deviation. You know, if you put it on a couple of days before, then the market could move 3 ticks or, you know, a couple of points or whatever. And now all of a sudden your calls may be at a half a standard deviation away, and your puts are at, you know, standard deviation and a half away. So your risk for the downside, in a sense, almost becomes incrementally more, which is why I would like to wait until that last moment. Does that make sense? Why I try to put that on at the last minute, so I get a clean, I know my one standard deviation move from there. I know my exact probabilities going into that trade. All right, does anybody else have any more questions? I think I covered everybody's stocks, didn't I? Oh, somebody wanted U.S. Steel, I think. U.S. Steel, right? Is one. This is a thorn in my side right now. I was long some puts in there, which I hate doing long stuff, but I just wanted to take advantage of low implied volatility in a market that had really rallied. U.S. Steel has had a banner run for a while, and I was looking for it to come back off. It just really hasn't. I was looking for it to come back down to like this level, and it just hasn't. So, you know, that's why I don't like buying just puts. I hate buying options. Anyway, but I needed to add some deltas, which is why I did it. Just a different portfolio adjustment. Anyway, so with U.S. Steel, it's at a big run. I agree with you. I think that it could be a little overdone at this point. So I would look to go to like the 16 delta or maybe even the 18 delta in this regard, because you can look at, it's really up against a lot of resistance up here. So if you could sell it at 39, that would be great. Let's see if we can. I think I was looking at the 30. So yeah, the 39 price, which would be that 52-week high in a sense. I never really mind selling 52 week highs. So we're getting about 33 cents. We could probably look at getting 35 cents, or even just bettering the bid, 36 cents. That's what I'm talking about when you're, you know, as a quick note, because I'm selling this, the mid price it was giving me is 34. well, I can see the offer is 37. So I would put this trade in at 36 and see what happens. And by the time I go back to my page, you know, cancel, replace, adjust the price, confirm and send, I should know whether or not that trade was going to make it or not. And then I moved it down to 35, and then I'd put it back in again, you know. And then I'd probably go to like the mid price or whatever and let it sit for a little while, but incrementally lower it as you go on those. So anyway, I'd sell probably those 39s. That's the 52-week high, so that works out well for me. And then, you know, we're looking at 35, 34 cents. We got to pay for that. So let's just see what this would give us anyway. Didn't I just buy that? Oh, because it locked it up. So it's a 2-cent debit. So in this regard, I might, if I really like that trade, I'd go like that, go to 0. I wouldn't go into the negative, put that trade in there. By the time I go in there, adjust my put or calls. You can adjust your calls and collect a little bit more credit. Go to that. You get the 6-cent credit. So that would work out for me. Then, you know, that way you're really playing around with the market, making sure you get the best bang for your buck. If I could get that other one for nothing, then I would have done that. But by the time I'm going to know whether or not I am going to get hit really in the next 5-10 minutes. You know, sometimes you got to look at it on the floor. It was like, do you want the penny or do you want the trade? I usually want the trade, but you know, I do have my rules where I'm not going to pay a debit for this strategy. I'm just not going to. Not going to increase what I paid for the stock. I always am looking to reduce what I paid for that stock. Does that make sense, SP? Always try to do it for a credit. And if it doesn't get hit right off the bat, then, you know, go back in. And in this regard, I'd probably start out again, you know, try and go for like, you know, I got 3 cents to the upside. It's probably offered at 10 cents or something. So I'd probably start off maybe a couple pennies above, confirm, send, cancel, replace, boom, confirm, send, and then get to the mid price and let it sit if I didn't get filled. All right, well, we pretty much used up the time, not quite as much time as we used up last time, but anyway, this is the deal for this week. It's basically how to trade like the Wolfman for 36 bucks. I mean, you can't go out to dinner for that anymore. You definitely can't go to Top Golf and hit balls for that much. Anyway, if you want to learn how to trade like a real trader or like a professional trader, like a floor trader, which, you know, I always say the floor traders were the guys that really understood options and the nuances of it. This, I mean, talking about time decay and how to use that in your favor, winning trades, how to set your option screen or your trading screen up like this. Also, if you saw with my platform, how to set up your watch list. I talk about high implied volatility all the time. That's one of the most important things for me. I talk about how to set up your watch list using that and how to use delta to measure your odds of winning a trade. I mean, this is all about probabilities, you guys. That's what we're talking about when we're talking about options. It is increasing your probabilities of success. I mean, there's a lot of people out there teaching stuff about charts, and yeah, I do look at the charts and I see some validity in those charts, especially the market profile, which is the one that I really like to use because that really tells me the psychology of the market. But, you know, and I even look at Fibonacci, and it's not because I necessarily believe that, you know, because a leaf has so many veins in it that it's a reoccurring nature thing and it happens in trading as well. I look at it as because there's so many people out there looking at Fibonacci that it really makes it come to fruition in a sense by the psychology of the market. Everybody's looking at the same numbers. So
But this is really what it's about. I mean, this is how you can increase your success rate, is by playing the probabilities. Yes, you're going to have losers, but I also talk about in these different webinars on how to manage that, especially in my daily market commentaries. Also with this, all of these videos, you know, trading around dividends, trading around stock splits, all of that stuff, how to manage your portfolio against rising interest rates. The Fed's already said it's going to raise another 75 basis points. If you have bonds in your IRAs, which most people do, this is how you can protect that, because as interest rates go up, you're going to get decimated on that portfolio value. It's just the only way to stop that from happening is to start trading options around that. That's really the best way to do it, lowering that basis of what you paid for it, because that price is going to plummet. And other ways to protect your portfolio with options. All of these things, plus you get the daily market commentaries. I know this week, I'm sorry for those guys, I know a lot of you guys were reaching out to me about the daily market commentaries. I was struggling with my recording software this week. It was on the fritz. I got a new computer and it did not like the fact that I downloaded Camtasia on a different computer and everything was going crazy. It wasn't recording any sound. So sorry about that. But you get the daily market commentaries where I talk about every single trade I do. I mean, I talk about the good, the bad, the ugly, and how I'm managing those. Just like Lulu's trade, I did an earnings trade on that. It went against me, and how I'm trading around that. So I talk about my losers more than my winners, and I'm not ashamed to do that, because at the end of the day, we all are going to have losers, and it's more important to understand how to turn a loser into a winner than it is to take profits on a winner, as far as I'm concerned. I mean, I talk about how to take profits on your winning trades in every one of my webinars, but we don't often get the opportunity to get into the nuances of how to really manage a loser and turn that into a winner, which, you know, I quite often am able to do, and I talk about how you increase your probabilities of success doing that. So, I mean, I turned Lulu from basically a $7,000 loser into, right now I'm down about maybe $800 on that trade. So, but it's still it's working out every single day. So, and I turned Twitter into a massive loser into a profitable trade over the course of time, when I was long calls, or sorry, I was long calls in there. No, sorry. I was long the stock in there and was selling calls against it, lowered my basis over time, and turned that into a winner. So basically all of this stuff is really how we did it on the floor and stuff that I've learned there. So some guys will reach out to you, or you can reach out to us at ProTrader Strategies. Trading at ProTraderStrategies.com. The other thing is, this link is in that chat box, so you can easily just click on that right now and go straight to it, or you can jot this down as you go. So all of these techniques are designed to help produce consistent winners. All right, so you got to take advantage of it. And for 36 bucks, I mean, you guys pay more than that in a commission day. So the only thing we can really do to increase our success is increase our knowledge in that gray matter, that 6 inches of gray matter in between our ears. All right, and this course could pay for itself many times over, just in even one trade, especially if it protects you around an earnings event or something like that. So take advantage of that. The other thing is, I want to thank you guys all for joining me, and later webinars, we're going to be drilling down on other options components and how I trade options, where I find trades appropriate. You can use this link right here. It actually doesn't click through. The one that'll click through is the one that's in the chat window, not the questions box that we've been communicating with, but in that chat over on the side there. But if you rewatch this again, you can tell them that you got this link from me. Also,
like I said, if you have any questions, reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. Another thing with this that I mentioned with the that's not on here, the market commentaries, but I also have a no inbox policy, which means if you guys ever reach out to me, I am going to do my best to get back to you immediately, because I know how when a trade goes against me, especially when I was learning, I wanted some answers. I wanted to bang some ideas off of somebody else. I'm there for you. Reach out to me. I will get back to you. And if I can't explain it in, a couple of sentences rather quickly, or maybe a paragraph or so, I will reach out to you via the phone to make sure you guys are successful. So take advantage of that as well. I know a lot of you guys have been with me with emails and getting a lot out of that. So that's what I want to hear. And some people ask me, why do I do this? Why do I throw all this stuff out there? At the end of the day, we all have our different ideas. That's why I'm like, implement this in your own way. Somebody could be long Apple stock and, doing a spread against it. Listen, I may not have that same idea with stock. We could both be profitable. But the thing is if all of us are out there trading and are more knowledgeable, we're creating tighter markets in some of those stocks like NVIDIA, where this bid ask is a little bit wider than our parameters are saying. If you guys are all in there trading, we can have different ideas, still be profitable. I mean, I could sell you a call and we could both make money in a sense. So depending on what you had against it and what I was doing against it also. So it's the beauty in options is it's not you have to have a winner and a loser. The beauty in options is, you can have multiple winners for every trade because people are doing different things. So I just really want to create a tighter market at the end of the day so we can all do better. OM, the link is in the chat box. So part of the go-to meeting, there's like a chat window and a questions box. We've been going back and forth in the questions box, but the link is over there in that little area where it says chat. You can kind of expand it out and there's a link there to get you directly to it. All right, guys, I appreciate it. Thanks for joining. I love all the questions. Another thing is, give all of the questions out to me. Barrage me with questions, because if you guys have a question, or one of you has a question, somebody else has had a question, they just haven't really asked it yet. Oh, that goes to Facebook. Shoot, let me see if I can do this real quick. I'll throw it in there. Facebook. Who wants Facebook? All right, hold on a second. Let me get my arrow. See if I can do this real quick. I can't do that. Shoot. I guess. Oh, what can I do here? Let's see if I can do this. Let me try one other thing. Bear with me, you guys. I'm on it. I think I got an idea. I think I could do this. Copy and see that go out. You guys getting that? That work out? Try that link for me. Can you, OM, just make sure it worked for everybody? And a couple of people just click on it. You don't have to actually purchase that right if you weren't thinking about it. I want to make sure this is working. Seems to be working. All right, I think we're good to go. Thank you guys, everybody. Appreciate it. Where is the link? It should be in the options window there, and it's going straight to, it's not going straight there either, is it? All right. Why isn't that? Let me try one more time. I'll try it on mine. See if it's working for me. Yeah, it seems to go to members area. I mean, I don't know why it's taking me there. Reach out to us, you guys. Facebook link. I put a couple of other ones in there, but it's going to the members area. I'm not sure why. This is the link that I had. But you can always reach out to us at, email us at the trading one. Give me 1 second here. Why is that going there? You can always email us here at Trading at Pro Trader Strategies and tell them you want this, how to trade options like the Wolfman. That's what I have wrong there. I don't have how to trade. It's how to trade options like the Wolfman. I have the wrong link. I'm sorry. I wrote it in. It's actually how to trade options like the Wolfman. Let me try this. Let's see if this works. One last time. I'm losing everybody. Hold on. Let me see if I can do this. There we go. Let's try this link. The very last one should be the one that works. Drum roll, please. There we go. That's the one. I left out options. I'm sorry, you guys. Let me see. Here, let me try. I can try something. That's not the right one, though. I don't know if I put that, how to trade options. I'll send this out for everybody to get it. I think I can send it to everybody. That go out? Everybody see that now? At the bottom. Appreciate it. Did you get that, Dominic? All right, great. All right, everybody can see it in their windows. Great. Sweet. All right, sorry about the snafu, you guys. Appreciate your guys' patience. Have a great weekend. If you can't take that, take it easy. You're welcome, guys. Take care.